first way, of course, is real estate and rental properties. And the reason why I put that as the number one tip is because it is probably the easiest. And if you have a job and you are able to get a mortgage, then that will give you massive leverage as well. Now, of course, one of the things you need to consider when investing in real estate is the rising interest rate. So you got to make sure that you're able to service the debt in the event that you're not able to rent the property out. Over time, I realized that, for real estate, people don't get a quote on their property every day or every second. So when you invest in real estate, it is actually a lot less stressful in that sense because you don't know if your property prices are going down like the stock market right now. So of course you want to allocate something to real estate. And I would say 50% because you probably need that amount for a down payment. If you're getting a condo or even just a small townhouse, I don't think that's even possible anymore. So yeah, a condo is probably what you're aiming for. And ideally, you want it to be cash flow positive. So if you're living in a low cost of living area or medium cost of living area, then that is possible. If you're living in a very high cost of living area like California, Vancouver, Toronto, then you probably need more down payment. Once you've got that taken care of, you can look at the second part, which is investing in something that is not real estate. Tip number 2, index funds. You have probably heard of, stock selection, stock picking, trying to time the market, but what if you don't want to do any of that? Well, then you would go with something called index funds. So basically, it's a very low turnover, passive investment where you just put money in there day in, day out, week after week, and you just don't worry about it. And the easiest way to invest without any headaches is just to put it in S&P 500. So you're fully diversified across the major 500 companies and is quite resilient to majority of the volatility or downturn. And only when you encounter a market crash once every 10 years, then you might encounter a correction. And at that point, you would simply just buy more and average down, and then you will usually be okay. Now, when you're looking at mutual funds or index funds, one of the things you need to pay attention to is the expense ratio. So ideally, what you're looking for is the expense ratio to be 1% or lower. So that is usually, what you can aim for. And if it is 2 to 3%, then you need to look carefully to see if it makes sense. Like after you deduct the expense, is it really worth it? And most of the mutual funds actually don't beat the market. So just stick with the simple S&P 500 would be fine. Now, in terms of allocation, if you are a complete beginner and you have no idea how to select stocks and do anything advanced, just allocate the rest of the 50% in there. That's 50K. So you're already done. You have real estate and you have index funds. And you can spend the rest of your time doing something else. Now, having said that, when you look at S&P 500, the average return year over year is around 8 to 10% a year. So if you want to have a higher return, then that's when you need to be more creative and you need to put in a little bit more effort to generate a higher return. Which brings me to the next tip. If you're looking to take a little bit more risk and want a higher return, then that's when you'll look into something like cryptocurrencies. Now, if you have heard of cryptocurrency like Bitcoin or ETH or other shitcoins that people are promoting, you'll notice that it is very high risk. And it will offer you a higher return, so then you do want to allocate some money to it. And there are a couple of reasons. So the first one is, well, if cryptocurrency ends up being a very important part of the internet and people start spending money, buying groceries, buying a car with cryptocurrency, then, well, it is going to fundamentally change our world like we have never seen before. So even though you might not be a crypto fan today, or you might not be into all these new coins that are published every single day, I think it's worthwhile to invest a portion of your money into cryptocurrency in the event this situation happen. Now, is it going to happen tomorrow? Probably not. It would take 5 to 10 years. But if it does work out, then the payoff will be massive. And the second reason is because right now, a lot of governments are printing money, including US, Canada, China, and Europe and whatnot. So cryptocurrencies like Bitcoin has a finite amount of coins being published. So there is a limit on the number of coins that can be published, which is why there is a constraint and scarcity, which causes the value to go up. So if you are looking to invest in something like gold, which I treat that as very similar to cryptocurrency like a Bitcoin, then you should allocate some money into that as well. So if you're looking at cryptocurrency, I would think 5% of your portfolio to 10% of your portfolio would be quite reasonable, unless, of course, you're a crypto bull and you decide to put half your portfolio in there, which personally, I think that would be too much risk. In the event that crypto doesn't work out, then you lose half the portfolio, which I don't think it makes sense. So I think for most people, you're really looking for 5 to 10% of your portfolio to allocate into cryptocurrencies, and that will usually get you more than 10%. So if I'm looking at the growth of Bitcoin for the last couple of years, it's actually quite strong. I think it's more than 30% if I remember it off the top of my head. It is definitely something that is worthwhile to look into. Now, when you're looking to invest in cryptocurrency, this can be a whole new series on itself, but you do need another broker and you do need to kind of dig a little bit deeper into it. So you don't want to do that immediately because it does take some time. And if you're really busy, you have a full-time job, take care of the real estate and the index fund first, because you're only going to be putting like 5% or less into cryptocurrency. So get that done last. Tip number 4 is commodities. Now, a lot of people who are more traditional like to invest in something like gold and silver. And if you look back, historically, gold and silver, they do go up in price, or they like to invest in other commodities like futures and copper and zinc and whatnot. So if you're planning to invest in those, you do need to do a lot more research on it because it is a lot more complex. So if you're a complete beginner, then my advice is really to avoid investing in those because it's quite complicated. So here I have a chart for gold prices, and this is for the last 5 years. So you can see that it is generally going up from around 1,200 to almost 2,000 today. So if you just look at the last 5 years, it seems to be going up, right? So it makes sense to invest in gold. But then if you zoom out a little bit more, then what you'll realize that is there are commodities super cycle. So here, if you look at back in 2012, gold was actually at a high point of 1,700. But since then, it actually dropped for 5-6 years, which means it needs to be a long-term investment. And this consolidation period from 2013 to 2019 actually took a long time. So unless you are, investing in gold long-term, you're just buying a little bit by little bit, then I personally wouldn't worry about it. If you're doing futures, it is also quite high risk as well. So unless you know what you're doing, you don't need to explore this avenue until a lot later. And in the next couple of tips, I'm going to talk about some other avenues you can explore that are potentially easier. So then that would save you some trouble instead of investing in commodities. When it comes to commodities, I also know a lot of people like to invest in silver. If you look at the silver price, historically, it is actually quite flat. So if I actually zoom out for the last 5 to 10 years, it is actually relatively flat, and there's only a boost near this COVID period. So unless you know the market really well, you're not really getting a lot of capital gain from it. Even though people are saying that silver is the new gold, silver is the new gold, it's not necessarily true. So since 2011, silver just hovers around a very large range from this, 10 something dollars to all the way to like 40 something dollars. So it is not really a strong trend. So just because you hold silver for 10 years, it doesn't mean it will go up. So like I said, if you're a complete beginner, I would actually avoid investing in commodities. Tip number 5, bonds. So when you are going to the bank and you walk into one of the financial advisors, they'll be like, oh, based on your age, you should do 80% stock and 20% bonds. And if you're getting older and older, this ratio will change over time, like 50% stocks and 50% bond. And then when you get really old, then they'll be like 20% stocks and 80% bonds. Or until you get to a certain age, like retirement, then basically you would have very little equity and just all bonds. Now, one of the problems with investing in bonds is that the return is like 3-4%. So the return itself is actually quite low compared to like index funds or real estate. So if you already have your hands full with the first 2 categories, I actually do not think you need to invest in bonds. Because when you're investing in bonds, 3% return, you need to compare that with what the inflation return is. And if inflation right now is 7% to 8% in the United States and 6-something% in Canada, then, well, you're actually losing money every year by investing in bonds, and you're losing 3% because your bond return is not catching up to inflation. So unless you're over 60, 65 years old, I actually don't think you need to invest in bonds. And usually the way people invest in bonds is really a way to park your cash, kind of like treasury bills, and you think that there is a recession coming, so then you put all the money in bonds, and then you wait for the recession to happen. Now, the problem with that approach is a lot of people are not good at predicting recession. Like, I think for the last 5-6 years, every single year, some economist will come out and tell you that a recession is coming, a recession is coming, a recession is coming. Now, in 2022, turns out there is a correction in S&P 500, and a lot of technology stocks are actually going down. But if you think about the earliest time people start predicting a recession, let's say it's 5 years ago, and you invested in bonds during that time, then you actually missed out 5 years of gain in return to try to enter at this 1 year of down period, and whether you think it is cheap enough. Now, I know some people that think, hey, it is not cheap enough. I think I should wait more. I think a bigger recession will be coming. So it might happen that way, but if it doesn't happen, then you already lost 5 years of growth in the capital market. You have 5 years of inflation against you, and the return for bonds is simply not high enough for this day and age. When you're looking at all the governments printing money around the world, I think investing in bonds is really a disadvantage to you as a beginner. And if you just stick with real estate and stocks, you'll probably be much better off long term. So I'm talking about 5 to 10 years. And once you get to a very old age, maybe you have like 2 million or more in your portfolio, and you really want a predictable income and you don't know any better investing strategy, then yes, I think bonds is a great alternative. Getting your 4% a year. If you invest $1 million, that's 40,000, which is more than enough to cover all of your expenses. But if you're young and you have $10,000, $100,000, then, well, investing in bonds is not going to give you that much return anyways, so you don't need to bother with it. Tip number 6, stock investing. Now, this is such a big topic that I can talk about it for hours and hours, but if you plan to get a higher return and you decide to go down the stock selection route, here are a couple of tips to help you avoid a lot of the mistakes I made in the past. Now, the first thing you need to decide when you're investing is whether you want to be a long-term investor or a short-term investor. And it is actually quite simple. For short-term investing, you need to dedicate around 10, 20, or even 30 hours a week to monitor the market, and it's quite stressful. So if you have a full-time job, then I don't suggest you to be a day trader or a short-term trader because it is usually not worth it. So you want to be a long-term investor, so then you're mainly looking for buy and hold, and you're mainly looking for companies that are great for many years to come. So you're not trying to ride the hype train. That will already save you a lot of pain. You're not trying to invest in the latest IPO stocks because your friends recommended it. So stick with the blue chip stocks and you will be fine. So that actually brings me to my next tip, tip number 7. Between penny stocks, small caps, medium caps, blue chip, go with blue chip stocks. It will save you a lot of pain. And even though penny stock can go from 1 penny to 2 penny, which is 100% return, most people will lose money because penny stocks are easily manipulated. So there are a lot of instances where you can get pumped and dump. You can actually research what that means. But basically, someone can buy a lot of shares, release some good news to boost that stock price, and then dump the shares. And this happens a lot with, newsletters, like YouTubers promoting a stocks or whatnot. And this will lead to all of his followers or subscribers to lose money, and that is pump and dump. So you definitely want to avoid those. Stick with the blue chip. It's a lot harder to manipulate, and even hedge funds, mutual funds cannot easily manipulate it. So once you do that, you should be on the safe side. Then it's just a matter of your research, which requires fundamental and technical analysis, and then your timing and patience as well. Tip number 8, technical analysis. So if you don't know what technical analysis, it is really the study of chart and pattern when it comes to investing. So if you do want to go down the stock investing route, then you will eventually come across technical analysis. Now, one of the problems with technical analysis is that it is incomplete. So it is not a full investing strategy. So you do need to combine that with fundamental analysis as well. But basically, what you want is the ability to enter at stocks at a discounted price. So here is Apple. And one of the tools I use, or this website, is called tradingview.com, which you can register for an account for free. And if you set up your chart correctly, it will help you identify entry points and exit points a lot easier. So if you want to get this template on how I analyze stock patterns, then you can look at the first link in the description below to get the technical analysis templates. I'll walk you through how to set it up and how I use this template to buy and sell as well. So for example, if you're looking at Apple, you can clearly see with this template that the trend itself is very strong. So you can see the price goes up, over time. And then afterwards, you also see that, hey, there are some areas where you can easily enter. And, that is where my mouse is pointing to. So if you're able to buy at the dip, then of course you'll be profitable faster and you'll also get more protection as well. So that is really the purpose of technical analysis, is to analyze the historical price pattern to find out whether the stock is at a discount or not. And this becomes especially important in a bear market where some of the stocks are falling. And if you don't enter at a discount to start with, then you might be buying at the highest high. So if you're investing money into the stock market and you end up buying at the highest high, it will take many years for the stock to recover, or it might not even recover at all. So that's why you need to learn technical analysis. Tip number 9. Now, as you go through your investing journey, you will inevitably come across leverage. Now, you use leverage in real estate kind of like a mortgage, where you put down a down payment to buy a house, so you don't need to use all cash to buy a house. You can do the same thing in the stock market, and there are a couple of ways to achieve that result. The first way is margin. So this is very popular, where the broker will lend you money to buy stocks. And after testing it many times, I think it is not worth it to use margin. So if you're just starting out, you're a complete beginner, you don't know what's going on, don't use margin. Stick with cash you have and invest from there. Now, the second way you can get leverage is options. So this is a very advanced topic, and you probably wouldn't touch on it until you start going down the stock selection path. But if you're able to learn options, and for example, I use options to invest as well, then generally you're looking to multiply your return by 2 to 3 times. So if you're investing in the stock market and you generally aim for 10% return, then using options, you're really aiming for a 20 to 30% return. I think that would be reasonable. Now, I know some people on the internet, they like to aim for 50, 60, 70% return when it comes to using options. You got to keep in mind that the best hedge fund in the world makes around 60% a year. So I think in order for you to consistently achieve 60% or higher, it will be very difficult. It's not impossible, because I know how it can be done, but it requires you to take a huge amount of risk, which is usually not worth it. So if you are planning to use options, then I think stick with 20 to 30% return as a goal would be great. So personally, when I'm investing in a market, my target is to make 30% return a year. And for the last 6 years, including all the downturns and market crash that we're seeing, my average return is around 31% a year. So it's pretty good, and it is possible to achieve that kind of return long term, but you do need to have a very low risk strategy. So you try to reduce the risk as much as possible. You need to learn how to do research, and you need to have a good option strategy together. Now, the 10th tip is monthly passive income. Now, when you're looking at all the different streams of income you can produce from investing, real estate gives you rental income, stocks give you dividend, and crypto, technically you can stake it as well to earn some interest. But so far, I think for dividend, you're really looking at around 3 to 7% return. So I don't think it's that high, So if you're aiming for a high return in terms of monthly passive income, then that is actually something you can achieve with options as well. So again, it is an advanced strategy, but when you get to that stage and you start learning about options, and as you get closer to retirement, then monthly passive income becomes important. So that's why when you're learning investing outside of real estate, there are two strategies you need to learn. So the first one is long-term investing, and the purpose of that is lower tax, and you want to hold on to good assets, companies over time. The second one is monthly passive income, and you'll need this when you're closer to retirement because, well, you need a more predictable cash flow, and S&P 500 or blue chip companies can be too volatile for you to invest in, and all you want is a predictable monthly income. So this can be achieved with dividend stock, of course, and also options as well. So that is something I do teach within my program called Investing Accelerator. So those are really the 10 tips for beginners to how to invest 100K. And if you do plan to invest in stocks, I think a good allocation will be around 20% of your portfolio where you manage yourself. Now, if you're completely new, then I would allocate maybe 10% first, if it makes sense. So that would be 10K. So that will allow you to invest in 5-6 stocks using shares so that you can test out whether you can make it work or not. And if you cannot make it work, then of course you can just go back to index funds. That is totally fine. And of course, if you are able to make it work, then try to aim for 20 to 30% if you are learning options. If you don't learn options, just using shares, just aim for 15%. I think that would be a pretty good return over a long term already. So that's pretty much it for this video. And one more thing, if you like this video, please smash the like button and hit subscribe. My name is Eric, nice to meet you, and I look forward to posting more videos about this. So you can leave a comment below to let me know if there are any questions you have. So if you go down to the description and look at the first link in the description, I do have a free training that teaches you how to invest, and I explain my investing strategy as well. So it is around 2.5 hours of free training on investing. So if that is something that interests you, you can click on this link and register for the free webinar.